If you're anything like the average person, you've developed some less than ideal money habits. But as long as you master some of these important concepts early on, you'll be well on your way to being wealthy. Learning them at a young age will make it exponentially easier for you to be incredibly well off, while those who never learn them will find themselves in a constant state of struggle. These are some important money concepts you should learn as early as possible, and make sure to stay to the end to hear one concept that will completely change the way you think about money. Welcome to WealthWise Academy, where we help teach people about money, personal finance, and investing. If you want to become financially free and not have to worry about money, make sure to subscribe to the channel and like the video if you find it helpful. Net worth. Net worth is a measure of your financial health, and while it doesn't show the entire picture, it does provide excellent insight into your situation. In short, net worth is the total value of every item you own, in addition to the value of all bank accounts, retirement accounts, and everything else in your name, minus any debt you owe. Assets minus liabilities equals your net worth. Beginning to track this figure at an early age and keeping an eye on any changes can be a great help because you can easily see your progress over time that would otherwise be hard to see in the short term. You're in a good place if your net worth is in the positives, but many people find that the net worth is negative and they have a lot of work to do. It's incredibly helpful to keep track of your net worth so you can see progress from year to year when it can feel like you're not making any progress from day to day. Inflation. Most people know that inflation causes the purchasing power of the dollar to decrease, but there's more to this that isn't considered. As the price of goods rises, the dollar doesn't go nearly as far as it did previously. When inflation is 5% per year, the dollar only has 95% of its value after 1 year, and the value of a dollar is cut in half in about 14 years. At this rate, you must be aware of the effect this has on your income when it's time to negotiate your pay. When your boss acts like they're doing you a favor by offering you a 3% raise each year when inflation is 5%, you're essentially getting a pay cut of about 2%. In this case, a 5% pay adjustment doesn't even mean an increase in pay. Cash left uninvested in a bank account is most likely losing value to inflation too. A savings account that pays 3% interest when inflation is 5% means you've lost 2% of its purchasing power over the course of 1 year. This isn't a big deal for small amounts of money over short periods of time, but something you need to consider for extended lengths of time. Liquidity. When it comes to deciding where to put your money, you should understand liquidity or how accessible that money will be. Cash or money in a bank account is very liquid because you can access it quickly and easily with no cost to you. Alternatively, retirement accounts have many benefits, but liquidity is not one of them. Money that goes into a 401k or IRA is not intended to be withdrawn until you reach retirement age, and you'll be subject to fees if you decide to take it out while you're still young. In addition, you risk losing money if you decide to withdraw from investments that fluctuate substantially in value. Investing money is great, but you need to understand that the money is basically inaccessible in the near term. So, be sure to have proper savings in place so you won't need to cash out anytime soon. Should you find this video helpful, subscribing to our channel would be a significant gesture of support. Our team of experts has invested considerable time and expertise to thoughtfully assemble the very best content, all with the aim of saving you valuable time and effort. Your subscription holds special importance to us, as it encourages our ongoing efforts to provide you with top-notch content and assistance. Interest. Interest is a double-edged sword of which you must have an understanding. When it comes to saving money, earning interest means your money is working for you, and this is obviously a good thing. When you borrow money, you're paying interest to the lender for the ability to use their money. This can be good or bad depending on the circumstances. In general, paying interest isn't a bad thing if it allows you to generate more income than the interest you're paying. For example, an investor would be happy to borrow money at 5% interest to purchase a rental property that will provide them with a 10% return on their money. A car buyer might elect to finance the vehicle at a 0% interest rate and invest the lump sum instead. The borrower doesn't mind paying interest in this type of situation because it's still beneficial to them. It's clear that paying high interest rates is irresponsible, but some forms of low-interest debt can actually be of benefit to you. Compound interest. Albert Einstein famously said that compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. The reason compound interest is so incredible is that when you invest, your money grows exponentially, and it becomes easier and easier to build wealth. Each year that goes by, you earn interest on the interest you earned previously. The result of investing over an extended period of time is that most of the funds are interest earned, while only a small percentage is what you earned and put away. It's not necessary to work and save millions of dollars for a retirement when compound interest will do the heavy lifting for you. If more people understood this amazing concept, certainly more people would utilize it and begin investing even a little bit of money consistently. Market crashes. Market crashes are actually a normal occurrence and shouldn't be cause for alarm. Yet each time one occurs, panicked investors lock in losses by selling everything. Stock market crashes or bear markets when prices drop 20% from their all-time highs are pretty common and are something investors should come to expect from time to time. It's best to be aware of these situations before investing considerable amounts of money to avoid reacting. Since 1928, the S&P 500 has dropped 20% or more on 22 different occasions, with such a drop happening on average every 4.5 years. It takes the market an average of 388 days to recover from a bear market. If your plan is to be very wealthy, you need to understand that these situations aren't unusual, and it doesn't mean the world is ending. So, selling everything in a panic is usually not the best thing to do. Risk tolerance. You should understand how tolerant of risk you are when it comes to investing. If the stock market is a roller coaster, risk tolerance is how comfortable you are weathering the ups and downs. Someone with a high risk tolerance might get excited during a market crash, as they see this as an opportunity to be more aggressive with their investments. Risk-averse people tend to be less aggressive and perhaps be deterred from investing entirely. Risk tolerance doesn't just come down to emotion. It depends on how much time you have to invest based on factors like your age and future earnings. Too much risk can result in a complete loss, while too little risk can cause you to lose out on compound interest. When investing in the S&P 500, an individual should understand that the price drops 20% or more every 4.5 years on average. Consider target date funds or an S&P 500 fund to land.